Morning, everyone. Thanks for joining me today for our webinar on cash flow made easy. My name is Kristy. I'm a presenter and an advisor for Business Station as part of the Digital Solutions Commonwealth Government Program. I have owned and managed my own businesses, and my feedback and my experience on cash flow really comes from this. I'm not an accountant or a bookkeeper as such, so a bit of a disclaimer there. And really what we're going to talk about today is maximizing your cash flow and really understanding your cash flow. And like I said, that's really more from the operational side of things. The webinar today is designed to be as interactive as you'd like to make it. So please use either the chat or the Q&A functionality to ask questions at any time. Do keep in mind, I'll stay on at the end of the webinar for a few minutes to allow for any questions that you might have then as well. So in terms of what we're actually going to cover today, in this webinar, you'll gain an insight into the cash flow process and how you can manage it as a small business owner or a manager. We'll discuss what cash flow actually is and talk about the difference or perhaps even the relationship between profit and loss and cash flow. And you'll learn how to create your own cash flow forecast, as well as how to develop more of an analytical approach to cash management by effectively tracking your performance. And then finally, we're going to look at strategies to stretch your cash flow even further. So quite a bit to get through. But before we get started, we'll talk about cash flow. What is it? Cash flow is a term that is generally used to describe the amount of cash in actual dollars that's generated or consumed in a given time period. So cash flow has a lot of uses, both in operating your business and in performing a financial analysis of your business as well. I think it's one of the most important metrics in all finance and accounting because it really symbolizes the lifeblood of your company. Understanding your cash flow allows you to evaluate that flow of funds into and out of the business. And that really opens you up to be able to identify where and perhaps even when there are potential problems. Now, understanding that cash flow, I think being that it is the lifeblood of your company is a key to your business success. As you find out how to manage it, then you'll be able to learn ways and discover ways that you can stretch your cash flow even further. Now, I often get the question of cash flow versus profitability. Profitability tends to be the ultimate goal when it comes to the financial side of running a business, but you don't generally determine true profitability until the end of a period of time. So normally, end of a financial year is a pretty typical time frame in which you would assess profitability. So that's really the key difference between cash flow and profit and loss or profitability. Profit looks backwards, so it's retrospective, whereas cash flow is forward looking. We're forecasting in a cash flow sense. Now, profit is really the amount of money that's left over after all of your expenses have been paid. And like I said, typically a financial year, but perhaps even a quarter. And making a profit very simply means having enough sales of your product or service to cover those existing costs, which are your expenses. And hopefully you've got that little bit extra to spare. Now, cash flow indicates that net flow of cash into and out of a business at any particular time. So it can be outlined in weeks, it could be months, or it could be years, really depending on how you set up your reporting. The most common that I see tends to be monthly, but then you can obviously group that and assess it further. But you don't typically see cash flow split down or broken down into weeks. That's quite intricate, but it really depends on the nature of your business and the products and service that you're selling. Now, cash flow matters, and it matters a lot in my opinion, but why does it matter? Well, having good or positive cash flow means that you're going to have enough money to pay all of those expected expenses when they're due. You'll know that you're able to reinvest in the business or potentially purchase capital or other assets that might be required to grow your business and run it more efficiently. You'll see when it's appropriate to return money to shareholders or perhaps even take money out for yourself. And you'll also be assured that you've got a bit of a buffer to cover you against any future financial challenges that might come up. Now, this could be things like unexpected equipment failure that requires complete replacement. There could be legal expenses or anything else unforeseen in your business. things do pop up. So you need to be sure that you can cover them. Now, having cash flow problems means that you don't have enough money in the bank for those necessary things, let alone anything unexpected that could arise. So you need to be mindful of that. This really allows you to be certain that you can cover at least the essentials. Now, having cash flow, what was I going to say? Just in terms of profitability, you need to keep in mind that you can have profitability, which is a really key and interesting thing, yet suffer from cash flow problems. So if you've got things like clients that pay late, you might have bad or early paying terms for your suppliers. That tends to be the main reasons why that can happen. So if you figure out your cash cycle, payment terms tends to be one of the very first things that you have to have a look at to keep cash flow positive. If you've got an existing business, I would recommend that you continually analyze this. If you're a startup, the very first goal has to be to maintain a positive cash flow. And once that's under control, you can pursue that sort of ultimate goal of making it as profitable as possible. Okay, that was where tracking comes into it. So tracking cash flow allows you to operate profitably and generate positive cash flow, or make necessary changes to improve that cash flow. So for example, you might identify that you need to reduce certain expenses, or you may have periods of time where you have to increase revenue in certain areas. It will really allow you to look at what's working well and what's not working at all, or what times it could be, again, a timing perspective, times of year that aren't working well versus times that are. You can set budgets based on what you know you need to achieve at certain times, and then track that to make sure that you're meeting that budget. It also allows you to be sure that you have enough cash. And if you don't, you're going to have to determine how you can get input. Now, that would take time, but you might have to input money personally, and you need to plan around that. You may need to seek investors. You may have to sell off assets. So you really have to identify those kind of issues early so that you can allow time for that planning. It also allows you to make informed decisions on various areas of your business, and that will include purchasing, staffing, sales, leasing, whether you're renting space or not, all of those kind of things. And with all of that knowledge, you'll be a lot closer to reaching your business goals. Okay, so that's where creating a forecast comes into it. Because cash flow matters so much, it's only natural that you should do everything in your power to increase it. So forecasting and knowing exactly when you're going to have those inflows and outflows is absolutely crucial. To do that, you have to map it all out. Now, there's a number of ways that you can do that, and there are tons of different templates available online. I find that the best are those from the Australian government website, so business.gov.au. But banks and a range of other websites have them. Normally they're downloadable. Generally speaking, they're in an Excel format, and I have not had to pay before, so normally they're free. So I will show you an example of one that I like to use in a minute, but yeah, seek out your own cash flow forecast. They're generally, when you do find a template, they're pre-populated with formulas in there, and you'll have a fill-in format where you just drop your specific figures in. Once you've got your template, first of all, to get started, you have to decide the period that your forecast will cover. Normally it is financial year, and normally it's month on month, depending on the nature and seasonality of your business. You might do it calendar year, or however you do that, you will decide that. You add in all the cash inflows, so any money or funds coming in, and then deduct the cash outflows for each period. For existing businesses, a really good way to start that is to just get all of your data from previous years, perhaps from your accounting software, and input that into your forecast. So if you know you spend $100 a month on internet, for example, and that's what you've done over the past 12 months, then just input $100. You might then later start to look at those individual aspects and go, all right, how can we get that $100 down? Is there a better plan available? But at a very starting point, input all previous data. You can then decide what adjustments you'll need to make. Now, those adjustments could be based on past trends. So you could have some big expenses there, for example, that you know you're not going to incur in the next period or in the next financial year. Sales wise, you might know that sales have been on an upward trend, so you can estimate a higher level of sales, or they may be decreasing, or even perhaps, you know, you would analyze and estimate that they would stay the same. So there are a few considerations there and a bit of analysis required on your behalf. Now, if you are a new business, when you're preparing your cash flow forecast, you have to start by estimating all the cash outflows. So this might involve getting quotes, looking at different elements of your business, things like insurance, all of your administration, any licensing costs, absolutely anything and everything that you can think of that is a cost to your business, and get as accurate pricing on that as possible. Once you've input all of the outflows, you'll get an idea of how much needs to come in to cover, at the very least, that cash going out. So that's therefore your baseline of what the bare minimum of sales you need to make are to just cover that. Now, do keep in mind that sales figures do change regularly because they depend on a lot of different factors. Now, that will be things like the types of customers that you sell to, how quickly they pay you, what the economy's doing. It could be interest rate increases. There could be, you know, fluctuations in unemployment rates. You need to consider what your competitors are doing. So there's a lot of different factors, and quite a bit of analysis might be required here when you're inputting the sales side of things. But be as realistic as possible, because at the end of the day, this is your forecast for the purposes of operating your business. So if you are unrealistic, you'll get to the end of that month, look back and go, we weren't even close, for whatever reason, or maybe you're way over, way under, who knows, but just be as realistic as possible and really deep dive into where you're getting these figures from. And then it will all make sense as each month ticks over and you do compare what you'd forecast to the actuals. Okay, so I'm going to show you through, or just talk you through, this template as a starting point. Like I said, there's a number of different templates available online. Now you can download them free. You can download them from a range of different websites. This particular one is from the Australian government website. It's very easy and simple to use. You can see here any of the areas in blue are where you can input figures. This particular one, if I was to change that to September, for example, it would change all the subsequent months. So it is for 12 months, but it doesn't necessarily have to start financial year. But the majority of people do look at things when they're setting budgets from a financial year perspective. Timing is quite good at the moment to look at financial year because we're coming to sort of mid-May. So that kind of, you know, you've got May and June, and then you can start preparing for the new financial year. So that timing could work well. Now, having a look here, first of all, you've got your cash incoming. So this could be any sales. You might be selling off an asset because you know that you've got something that you're getting rid of, or that you know that you need the cash. So input it at the date that you're going to receive the cash from it. If your clients don't pay at the time that they take their product or service, you will have debtor receipts to account for. So let's say you make the sale in July, but you've got a 30-day payment term, so the debtor receipt might not be until August. So do keep that in mind. This is all about timing. So what you're inputting here is when you receive the cash. Similarly, if you have clients that pay in advance, so let's say you've got a product that the clients pay you for now, and then they don't take it for 2 months to actually carry out the service, you're going to be inputting the sale when the finance was, or when the money was actually received. So keep that in mind. Just one thing I should point out here, you will always have an opening balance because it's about your cash at the bank. You're going to have an opening balance. So how much is in the actual bank to start off with, and that will obviously fluctuate. So what will happen here is you'll have all of your sales. It will total up your sales as a total of incoming. Then it will deduct all of your cash outgoing. Now, this is things like any purchases of stock, your accountants or solicitor fees, any advertising or marketing that you do. Don't forget bank fees, credit card fees, interest. You've got all your utilities, telephone, insurances, as I mentioned, stationery, plus wages, superannuation, and those kind of things. So absolutely anything and everything related to your business. So the outflows are going to be all running expenses, plus if you're buying any new assets or anything like that, do factor that in there. You might have one-off bank fees, an annual fee at a certain time. Loan repayments do have to be taken into consideration in that section as well. Also, don't forget, as a business owner, you may be taking out funds for yourself. And that is absolutely fine. If you're not paying them as wages, you may be taking them as direct drawings or something like that. It's really important that you do account for them on your cash flow. And we'll talk about this in a little while when we talk about things like cash flow mistakes. But I do see a lot of businesses running their business from their bank balance, and they go, all right, there's a bit of cash in there. I'll just take out, a few thousand here and there because I work for the business, I should get paid. And that's understandable. You definitely should get paid. However, it has to be planned. So I would highly encourage that this is taken up and factored in when it comes to your cash flow forecasting. So you've got your starting balance, you've got added onto that will be any cash incoming, and then taken off that will be any cash outgoing, and that will leave you with a monthly balance and then a running or a closing balance. So what you need to keep in mind here is your monthly cash balance is literally your cash incoming less your cash outgoing for that month. Whereas your closing balance will roll over your bank balance from previous months. So that's really important. You might know that July, being midwinter, is a pretty bad month in terms of sales. And so you make a loss in the month of July. So you might find that this is in the red here, this monthly cash balance, but because you already had enough funds in the bank, your closing balance is still positive. So you still roll over a positive amount here as you head into August. So that's really important to keep in mind as well. Just keep an eye on that. When I look at something like a cash flow forecast, I would always be looking, obviously your closing balance is important, but your monthly cash balance is really important as well. If there are any months that aren't doing well and you are in the red, I would absolutely be looking at addressing those month by month. Even though you can get through them because you've got those funds rolling over, I would still consider analysing that month in its own right. So that's a snapshot of a template. Like I said, find one that you like. Your accountant might have one. Your accounting software may produce something, but I like to do an Excel document where you can sort of manipulate the figures and you're not just relying on what's been input into your accounting software. Okay, so now we're going to look at once you've mapped out your cash flow and you're all set up to track it, there will be some areas, or there may be, or you'll be able to identify if you need to improve it. However, I will say that whether there's a profit or a loss showing on your cash flow statement, you should still look at ways to improve it. Now, the strategies for improving cash flow tend to fall into one of three categories. First of all, you've got revenue growth, then you've got operating margins, and then capital efficiency. So we're going to look today at some of the key areas within those three main pillars, but it's definitely worth looking at all of these areas of your cash flow. Obviously, you need to look at what's relevant to your specific business. Now, I would also keep in mind that a lot of what we're talking about here, it really is marketing. It's strategic marketing, but first you have to understand your position to be able to improve your marketing and then subsequently improve your cash flow. So just to expand on those three main pillars, first of all, you've got revenue growth. Now, this is the volume of goods or services sold or the price of what you're selling. So there's a few areas under that. Then you've got your operating margins, which is your costs of goods sold, and you're selling your general and administrative expenses. And then you've got your capital efficiency. So that's really just a question of how efficiently, I should say, you're using your cash to operate and grow. And that's looking at your property, plant and equipment and at your inventory. So we are going to look at some of the more common areas in more detail, but do have a look at this overview and have a look at each of these elements and think about what's relevant to your specific business. Okay, the first thing we're going to look at is pricing. Now, I work with a lot of businesses, and when I first start working with them, one of the things we talk about is pricing and what is their most profitable or least profitable products and services. And a lot of small businesses just don't know. They don't know if their pricing is right. They don't know if their prices cover costs, or what is more profitable in terms of the products and services that they offer. So thinking about that, do you know what are your most or your least profitable products and services? Do you know how you can increase those products that are more profitable and then decrease less profitable products? And also, have you considered how much time is invested in each as well, which is a major factor? Now, in terms of getting your pricing right, it's absolutely crucial that you do think about how you've priced your products or services. Now, there's 3 different kind of elements to look at when it comes to pricing. One of them is what it costs you plus a markup. Now, some people in a retail sense and the clothing industry or fashion industry tends to be one where they are just looking at what it costs them plus a percentage markup. However, you do also have to consider what your competition are doing. Are your competitors selling the same products or services for more, for less? And you also have to look at what the customer is willing to pay to know how many sales you're going to make. So all 3 elements are really important to have an effective pricing strategy. You can't just base your pricing on what it costs you plus a markup, because you might not be competitive. You can't just base your pricing on what the customer is willing to pay or what your competitors are doing, because you might not be covering costs or making a profit. So you have to analyze each and every element. I need to know what your competitors are doing, and you have to understand your worth and where that fits into it, the value that you're offering to clients. And through this process, identifying your weaknesses or any gaps in what you're offering is really important. So really doing that research on your competitors to make sure that you are really clear in what you're offering against what they're offering, and making sure that you're offering a fantastic product or service. And if you want to charge more, that has to be superior to your competitors. So that really does go back to a marketing strategy. What is it about your product or service that's unique or different or sets you aside from your competitors? Can you charge more because of it, regardless of what your competitors are doing? Or do you want to base your pricing on more volume, less profit? Now, when it comes to pricing, discounting equates to more work to make or maintain a margin, whereas increasing a price tends to be less work, but fewer customers to maintain the margin. But by increasing a price, you may cut out a certain market that just can't afford what you're offering, or that are very price focused. And then on the flip side of that, and I have seen this before, where companies will decrease the price and therefore attract the wrong type of market. Now, you see that there's some group buying websites where they buy bulk vouchers or deals off a particular company and then sell them for quite cheap. Now, I find that some of the market that you get, or the types of customers that you get from that kind of that sort of group buying sales process at a discounted rate can be wrong for your business. They might be harder to satisfy. They might spend less with your business. They may not be loyal. So really, you really have to identify what's a quick win to you versus what's going to equate to the right type of customers for your business. Now, only you can answer the rights and wrong aspects of that. Depending on the nature of your business, what you know about your customers, and research you've done as well. Okay, then we're looking at volume. Now, with volume, the question here is, can you increase overall volume, and specifically the volume of more profitable products and services to turn over more? Now, there could be a question about new markets to sell to, creating new products, or even better sales processes to allow you to produce more as well. There is a profit enhancement guideline, or we look at different types of profit enhancements, and these are outlined in the table that you see on the screen. So I'll talk through those. First of all, in blue, you see market penetration. That's where you've got an existing product in an existing market. Now, that occurs when a business penetrates a market that has current or similar products. So it's essentially gaining your competitors' customers. Then you've got the next area is product development, which is the green area, the green section that you see on the screen. This is where you're developing new products for existing markets. So thinking about that, can you launch a new product or service that might appeal to customers that you've already got? Maybe through what you've identified in researching your competitors, or through tracking general trends, you've come up with some kind of product that you can develop. Market development that you see in the orange, this is where you've got existing products in a new market. So you're essentially developing new markets. You're broadening your scope potentially to a market. And we did see this a little bit with COVID, where you would have companies that were predominantly an international market, and they had to broaden their scope to really attract a local market because international people weren't visiting. Or you have, a bricks and mortar store that's also gone online to attract a different or a global market. So that kind of market development certainly has happened a lot lately. So consider if there's something that works there to enhance profit for your business. Now, the fourth element that you see in red is complete diversification. So this is where you're looking at a new market and new products. So can you spread into completely new areas and sell something completely different to your existing core product? Now, there are risks associated with that because you don't know the market or the product, but it certainly can work as a way to enhance your profits and grow your business. Now, in terms of volume, I did mention this at the beginning, but you also have to consider what your sales processes are like. Is there any blockages in the process side of things? And could better processes allow you to sell more? So identify any bottlenecks in the process. Increasing advertising is always going to help. If it's done right, it's going to help sell more. Obviously, that has a spend attached to it. So you have to do your research and make sure that you execute a good advertising program in that sense. If you've got salespeople can really help small business. If they're good, then you have to have a good placing plan to retain them. If you need them, you need to have a good plan in place to attract them, essentially. Customer rewards programs, or anything that you can do to really encourage repeat visitation, repeat customers, repeat sales is going to really help. It costs something like 8 times more to attract a new customer than it does to retain an existing customer. So any kind of rewards or loyalty kind of programs are really going to impact not only your sales, but your bottom line. Debtors are a key area to look at to improve your cash flow. Now, a really interesting ATO statistic for debtors is that small businesses in Australia are owed about $26 billion at any one time because of debtors. So I would be very much encouraging you to not be part of that statistic. And the best ways to address any issues with debtors are really to collect payments as quickly as possible. Some businesses look at a discount for prompt payment, or on the flip side of that, you could look at introducing late payment fees. You really have to understand what is most suitable to your business. I would suggest that you could invoice earlier. Now, some businesses wait to the end of the month to invoice, and then they give, a lengthy period of time in terms of payment. So let's say you provided a product or a service at the beginning of the month. Let's say the 1st of the month, you didn't invoice to the 30th of the month, and then you had 30-day payment terms. So it's potentially 60 days that you're out of pocket for that product or service. So I would absolutely consider invoicing earlier. Now, if you do have customers that you work with that you invoice, let's say you give them a lot of different products and services throughout a month, you may even like to split that invoice and invoice at the 15th and then at the 30th of every month. So that you're issuing 2 invoices. Reducing the terms I mentioned, definitely reduce your payment terms, make it shorter. 30 days seems a bit crazy. 7, 14, 28 days tends to be pretty common, but I would look at reducing that as much as possible. I would certainly make it less than 30 days. Doesn't need to be that. Do they need that period of time to pay? I would try and shorten that right down to, so let's say 7 days. Now, electronic invoicing, there's some great stats around electronic invoicing and switching from paper to electronic, particularly invoicing that offers, or accounting software, bookkeeping software that offers follow-up services can have a really good impact. Now, electronic invoices are a lot more professional than paper invoices. They're a lot easier to send, to store. So obviously it reduces the workload from your end and reduces turnaround times. But that payment follow-up is really important as well. The more you can automate that, the less it's going to cost you in terms of payment follow-up as well. And the quicker that you get paid. So keep that in mind. Now, there is a new system or an emerging system called e-invoicing or electronic invoicing. Now, this is the automated digital exchange of invoice information directly between a buyer and a supplier's accounting system. Now, with the introduction of e-invoicing, you won't need to generate PDF or paper invoices once the supplier and the buyer are connected to the same e-invoicing network. You can use accounting system software like Xero to send and receive e-invoices. Now, the cost for an invoice, to send an invoice, whether that's paper or PDF, is around $30. When you look at this e-invoicing, that reduces down to about $10. So it is a massive cost saver. So have a look at that software. Now, the ATO are going to be bringing out a lot of information on e-invoicing. So government are all on these e-invoicing programs at the moment, or you're utilizing this these e-invoicing platforms, and they're really trying to educate small business on going that way as well. So certainly keep an eye out for that, and speak to your bookkeeper or your accountant about it. Now, the last thing that I'll mention in terms of debtors is make paying easy. And this goes across whether you've got debtors or just customers in general that pay up front. Offer multiple payment methods to your customers so that paying is easy for them. Have a look, it could be direct debit where, it's subscription based and they get that automatic direct debit every month so that you don't have to invoice them and chase them for payment. It could be that you introduce online payment as well as, direct debit and that kind of thing. So really keep that in mind. I've just got a question come through. If you're new to the market and do not have existing customers, is it market development? Yeah, so sorry, I'll just click back a slide just to show you that. It is market development because you are new to the market. Okay, so for you, it's a new market, but you've got an existing product, assuming that the product does exist on some level. So yeah, it certainly is market development. And market development is really, it's a cross between market development and market penetration, essentially. So it really depends on the history of your business, but it's one or the other, depending on the nature of your business, what the product is as well. So keep that in mind. Okay, so flipping over to assets now. Now, assets in terms of improving your cash flow, assets really is fairly straightforward. This is simply to look at if you can free up cash by selling an underused or an unused asset, I should say. Now, businesses tend to accumulate assets that at some stage you don't require anymore. So selling off these unnecessary assets increases your cash in the business. It obviously saves on costs, things like insurance and storage and that kind of thing as well. Obviously, you could consider leasing to free up cash. You would always consider whether or not that works out better for you. You can remove the cost of maintenance perhaps and the risk of complete failure requiring replacement if you do look at leasing. Also keep in mind that leasing smooths out your cash flow. So if it's appropriate for your business, it can be a really good way to free up cash. Refinancing is another good thing to do. You can look at refinancing or negotiating better terms with any existing loans or bank agreements that you might have. So do keep that in mind. Assets is pretty straightforward in that sense. Expenses is the next area that we're going to look at. Now, put very, very simply, expenses decrease the amount of cash that's available to your business. So I would think about absolutely anything and everything that you can do to reduce those expenses. First of all, looking at deferring expenses or looking at better payment terms around expenses. Obviously, the funds are better in your pocket than in someone else's. So those payment terms and deferrals obviously always work well. Looking at better terms. Now, that could be things like payment terms, as I mentioned, getting longer payment terms in terms of, what your supplier agreements are and that kind of thing. Looking at cheaper alternatives. Now, there could be a cheaper location. You could negotiate a better deal around any of the expenses listed. I should say, there could be new plans or technology packages. Some expenses you might be able to remove entirely. So have a look at reviewing all of those expenses. When was the last time you reviewed things like insurances and new tech packages and absolutely anything and everything that's on that expenses section of your cash flow forecast? I would also consider the comparison in outsourcing versus in-house staffing. It can be really effective for specialist roles or particular tasks within your business. For example, bookkeeping, particularly with more automation, that might be something you don't need someone sitting at a desk Monday to Friday to do. Perhaps outsourcing, you could really reduce the amount of time that it costs you for that particular role. Marketing or other administrative roles, that can also work for as well. You have to understand the nature of your business and the products and services and the industry that you're in to know whether or not outsourcing works, but I would consider it, absolutely consider it. Now, inventory, this might not be relevant to everybody, but inventory does represent cash. So if you're holding it for more than 90 days, for example, or more than any long period of time, it's going to cost you significantly. In terms of your inventory, think about whether or not you can source cheaper alternatives, cheaper stock, cheaper materials. Always review your pricing from suppliers and do it regularly. Now, you might have a supplier that you like to work with, that you've had a long-term agreement with. That's absolutely fine. I would still look at getting quotes from other suppliers, but then always go back to that supplier that you have a good relationship with and say, I want to keep working with you. I can get this product or this stock or these materials, whatever it might be, at a cheaper rate. Is there anything you can do? And if they want to keep the business, 9 times out of 10, they're going to come to the party if they can with a comparable rate. Purchasing power is a really interesting one. You have buying power when you understand your own cycle. So when you map out how much cash you have at certain times, versus how much stock you use, you can really clearly see if there's any efficiencies there. So going back to that cash flow forecast, if you had that overlay and you could see in November, you've got an influx of cash and you normally would need stock around that time, can you buy more at that time and get it at a much better rate that'll keep you going longer? So really have a look for efficiencies like that. However, with your stock, I would suggest that you always maintain the right levels wherever you can. You do have to make sure that your stock isn't too high unless there's some kind of trade-off, like an extremely low rate for the purchase power side of things that I just mentioned. You never want to run out of stock because it's bad for the customer experience, which will heavily impact your sales later. So really track the movement of your stock and have some good processes in place to identify when new stock should be ordered. You might want to return anything unused or unsold if you can. So really know your suppliers' return policies. However, in saying that, I will say that with COVID, what happened, when people first started locking down and businesses first started struggling, a lot of stock was sort of tried to be returned to suppliers, and therefore suppliers really got strict on their return policies. So that may not be an option, but think about how you can move that stock faster. Now, perhaps you have a bricks and mortar store, so you can go online as well as having bricks and mortar, or perhaps you're an online store and you can look at a pop-up or something like that to move stock. So keep that in mind. But I would certainly be using a software platform to manage your stock, or have a really close eye on it manually if you have to do it manually. But make sure that you're replacing slow moving and obsolete stock with stock that has a much faster turnaround time. So you have to, however you do it, whether it is manually or through software, you have to know what sells well and what doesn't. Another thing you can consider is drop shipping or just-in-time stock orders. You might be able to find suppliers who provide you with stock that is only when you need it. That way you're not going to waste money on paying for stock that's sitting, you know, in a warehouse or a storeroom or whatever. You only order it once you've had an order from your customers. But you do have to be really careful here. You have to make sure that there is no impact to the customer. Now, first thing with that is going to be that there's no delay on deliveries. The second thing with that is going to be that there's accuracy. So I have heard some horror stories about drop shipping where customers are getting sent all kinds of incorrect products. So you really have to trust the organization that you're working with if that's something that you're considering. And the final point there is, again, payment terms. Use your supplier payment terms, make full use of them, because that equates essentially to an interest-free loan. So if you've got two suppliers to choose from, one has 30-day paying terms and one has 7-day paying terms, but the products and services are equivalent, I would go with the one that has the better terms, because that is, like I said, an interest-free loan. When you are invoiced, don't pay your invoices early. Paying them on time is obviously important, ethically and in a business sense, but certainly don't get into the habit of paying things early, because it is you that becomes the middleman. And as a small business, that can leave you significantly out of pocket, which will become really evident on your cash flow forecast. Staffing is the next element we're going to talk about. Now, I have touched on this, but when it comes to staffing, it is really a key area that can become a major expense for businesses. In terms of staff management, firstly, obviously rostering to cover demand to produce revenue is necessary, but don't overstaff. So always match the roster system to peak periods, and potentially have flexible staffing arrangements in place to allow you to manage the flow of customers with the staffing levels. I did touch on outsourcing earlier, but perhaps consider outsourcing if there's specialist roles that you could outsource so that you're only paying on demand as such, rather than having a full-time employee in these roles. That can be really beneficial to small businesses. I would look at the flexibility of your workers. Can individual workers have multiple roles, or are they able to multitask as and when they're needed? Now, example of this is, let's say you had a storefront, but you also had back office staff. Can those back office staff get out and help out the front if the demand was there, and then go back to their roles? So just having not only staff that are willing to do that, but are trained to be able to be as flexible as possible and to be able to multitask. So it becomes not only a training, but also an attitude aspect of the worker themselves. Now, aside from multitasking or having flexible workers, making sure that you're utilising your staff to their maximum is absolutely crucial. So things like setting targets to maximise their productivity is a good idea, or incentivising sales. Perhaps there's commissions. Perhaps you even reward staff behaviour that improves cash flow. So, you know, reduces expenses, for example. As well as the sales target side of things. So that's a really great way to help with both reducing expenses or increasing sales. But if you are doing an incentive based on sales and commissions, and paying commissions, I should say, you do have to make sure that commissions are only paid when you have the payment from the customer. Because you don't want it, again, to negatively impact your cash flow. So making sure that that structure is set up well. The other thing is the qualifications of staff. So employing more qualified staff and paying someone that is more qualified can genuinely increase your sales and your customer satisfaction, which in turn creates that positive word of mouth, your repeat customers. So this is an interesting one, because unqualified or lower paid staff may look like a win on a cash flow forecast, but in fact, it can be really damaging in the long run. Now, I see examples of this kind of thing all the time, particularly in the hospitality industry, where you've got someone that's obviously highly trained, that's serving you at a table, for example, and their ability to upsell or on-sell you and really communicate with customers can mean that you spend a lot more with that establishment, as opposed to someone that isn't well trained, isn't experienced, doesn't know the menu. And so those kind of things, really consider that. And that might not be more qualified staff as such on paper, but really working with your staff on selling, upselling, suggestive selling, and those sales techniques to maximize the revenue that you're getting from every customer. Now, once you've got these amazing staff or you've invested in the training of them, retention is really the key element that you want to be looking at. Staff turnover is extremely expensive and it has a very serious impact to the bottom line. So reducing that staff turnover has to be the ultimate goal. Staff are expensive to hire. Obviously the advertising, the interview process, so that whole hiring aspect is really expensive, plus the training, and then that continuity as well. So really reduce those costs by being the employer of choice. Once you've got staff that are perfect fit for your business, do what you can to keep them. All right, so that covers some of the main strategies to improve your cash flow. Now, as you go through and complete your cash flow forecast, definitely keep those elements in mind. And then when you get to the point that you've determined if you've got a profit or a loss, you'll have to make some considerations. Now, when it comes to profit, don't be too quick to take it out. Definitely invest it back in to manage your cash flow for future months or years, or even use it to pay down debt. So do keep that in mind. You don't want to go, all right, this is great, I'm just going to take it all out now. You may need it in the future, and there are ways that you can efficiently utilize your profit. Now, if your forecast shows a loss, then you might have to input your own money. You may have to get new equity from investors. You may have to borrow to fill gaps. So you might need to speak to your bank about a loan, perhaps, or even an overdraft. Now, an overdraft is a very common solution to cash flow issues. Now, that could be because your business is seasonal, or it could be because you've got a large volume of debtors, so there could be a bit of fluctuation there. So an overdraft, generally speaking, depending on the history of your business and the turnover of your business, but most banks have almost like a approved overdraft amount. So you can contact them and go, I need an overdraft, and they might say, look, we can do that very simply and easily without an extensive application process at a certain level. So I would absolutely identify that. With an overdraft, you're only paying interest when the money is actually owed. So if it's seasonal and it's kind of coming and going, you can go into overdraft and then the money might come back within a matter of weeks. So you're only paying interest on that period of time. Now, definitely consider that, or like I said, as a loan, but any of those things do take time. So I would obviously, tracking and forecasting that allows you to be able to plan that and really work out what it is that you need. But the very final step, and I think the most important step of all, is to very simply review what you've estimated in your cash flows against actuals. So each month, you need to go back and check what you estimated against the actual cash flow for each specific period. Highlight if there's any differences between the estimated and actual, and it will help you identify why your cash flow didn't meet expectations. So it could have been lower sales than forecast or higher expenses, for example. You have to take different actions for different situations. So you have to understand the situation first and then take the appropriate action. But do remember that cash flow is all about the timing of and the flow of cash. So when you're preparing your cash flow forecast, make sure that you're as accurate as possible on the timing of the cash. So when you do the analysis, it actually all makes sense. So really take into consideration when the funds are coming in, particularly if it's debtors. If you make the sale in July, don't account for it until August if that's when the payment run or when the payment would be received. So really consider that. But do analyze that cash flow against actuals, and do it quickly at the end of the month, so that if there are any issues, you can identify them quickly and take the relevant action. Now, in terms of cash flow mistakes, there are some more common mistakes that we see. Now, the biggest and the most common mistakes that I see are, first of all, and I did touch on this, but running a business from your bank balance. It doesn't account for any planned or unplanned expenses, or perhaps even the seasonal nature of your business, whether you have a high and a low season. So, and I do see this is sometimes that a business will go, oh, yeah, things are doing well, take a ton out now, only to realize that in 3 months down the track, it becomes into their low season and they actually needed that money. So really don't run your business from your bank balance. Make sure that you are managing your taxes and government expenses properly. They're clear, they're known, so plan for them. So whether it's GST, it's super, it's PAYG, whatever it might be, there's penalties for late payments and they are simple to account for. So definitely do that in your planning stages and make it a part of that cash flow forecast. Another mistake I see is people spending too much money on sales. So as a small business, you obviously need new customers, but you have to be really careful and track that acquisition cost of a customer. Track the total revenue that each customer generates you, because it has to be higher than the acquisition cost. Now, overspending on the acquisition cost might lead to gaining a small value customer with a very limited return. So do be mindful of that as well. A lot of businesses have issues in that regard because they think that the more customers they have, the higher the profit will be, but discounting comes into account there as well. When you know your customer value and you know how much the acquisition cost is, plus the cost of sales, then you know how much you can charge or how much you can potentially discount if you're running promotions and that kind of thing. Not forecasting is obviously a big mistake, and hopefully after today you understand why. Not collecting cash fast enough is a big mistake. If your customers are delaying payments but your supplier terms are short, then you're the one that's caught in the middle. Unpaid invoices are cash flow killers, so do keep that in mind. Make sure you've got those strict follow-ups in place. Now, what's worse than late payments is invoices not being raised at all. So it does happen. You know, companies and companies I've come across in the past will forget an invoice here and there. Now, I'm always honest and you know, I tend to think that the invoice will come eventually. So, and I want to account for it in the right period. So I will generally follow these things up. But I'm sure there are businesses that don't, or customers that don't follow up invoices. So make sure that your processes and procedures are strict enough to make sure that that never happens. As a small business, you can't afford to be losing out on any sale. Holding inventory for too long is a mistake. It costs you money, which we discussed. Inventory represents cash. You don't want it just sitting there doing nothing for your business. Now, one last thing that I'll mention in terms of a cash flow mistake is taking too much cash out. You definitely need to take money out of your business. You need to make sure that it's accounted for as part of your cash flow rather than sporadically taking it out. You do, as a small business owner or a manager, obviously work hard in the business and they have to be earning money, but it has to be accounted for and planned for. Now, also keep in mind, if you suffer from negative cash flow, so if you've done this cash flow forecast and you go, oh my God, it looks terrible, it's all negative, that's absolutely fine. You can recover from it. You have to find out what's caused it in the first place. So is it expenses that are much higher than anticipated or sales much lower? You have to change your payment terms, reduce your operating costs, perhaps run promotions to get new customers, and then obviously speak to a lender or an investor to try and overcome anything more major. So hopefully that helps. Don't fall into the trap of any of those mistakes with the knowledge that you've gained from today. That does wrap up our session on cash flow. I hope it all makes sense and there are things that you can take out of this to improve, or at the very least to better understand the cash flow position that your business is in at any given time. Now, I'm going to stay on now and answer any questions that you might have, but keep in mind we have just scratched the surface. So if you want to know more or talk about any other aspect of your business, you can do that through this Commonwealth Government program, our digital solutions program that this webinar has been presented to you as part of. Now, for $44, you get 3 one-on-one sessions with an advisor of your choice, and we have a huge range of advisors. And then you get access to webinars and workshops as well. So do keep that in mind. There is some eligibility around that. You have to be have an ABN registered in WA, Queensland or NT, be operating for profit and employ fewer than 20 full-time staff. So if that's something you're interested in, please do reach out. And like I said, if you have any questions, shoot them through now and I'll stay on to answer them. But if not, thanks a lot for joining me and good luck.